Good evening. It is time for today's tax talk. I'm your host. I'm attorney Stephen Leahy. It is Tuesday, May 24th, year of our Lord, 2022. You know, the volatility in today's Crypto Tuesday. So we're going to talk about crypto. There's volatility's back. It's been the main story for the last couple of weeks about the volatility of all crypto. And so that's what we're going to talk about, because sometimes when there's volatility or when there's losses, sometimes there can be some gains. That's what we're going to talk about today. Won't you join us? Okay, well, that's what happens. So, as I mentioned, you know, the crypto is actually it's volatile, yes, but it's mostly down. It has been some have gone to zero. Some crypto currencies have gone to zero. There's some good stories out there about crypto. You know, about the Ukraine and how crypto has helped them. The story about El Salvador buying on the dip. They're all in on Bitcoin. Stories about in New York about what they're trying to do. Miami, what they're trying to do to maintain their edge, and whether crypto is really has a future, because there's many that are questioning now. Is there a future in crypto, or is that just a fad? Now, as you know, on this Crypto Tuesday, we also talk about blockchain. And blockchain is going nowhere. So, we're just at the beginning of the blockchain craze, I think, and all the things that are going to happen with blockchain. Crypto was just the first. Does that mean it's not going anywhere? The central bank of Europe, the commissioner there has said that crypto is worthless. Because it doesn't have anything backing it. Well, either does the euro, in my opinion. So, and I think that these governments are going out of their way to collapse crypto. It's a threat to them, in my opinion. But anyway, that's what. But let's do it as is our want. We generally will look at the market. Well, this is not what I want to look at. Here's today's market. Remember, on today's Tuesday, and almost every Tuesday we see a plus side when we do the show, and they're all on plus now. Bitcoin still is teetering on the $30,000 mark. It's been up and down from there for some days now, some weeks. Ethereum is up slightly. That the last one. Let's go down. This was for the 7 days since the last time we did our Crypto Tuesday, and talk about a roller coaster. That, my friends, is a roller coaster, up and down, up and down. Not really gaining anything for the last week, but taking some big losses early. So let's take a look at the weekly for Ethereum. Again, very similar, as we find every week that Ethereum and Bitcoin kind of mirror each other. I wouldn't say mirror, but closely parallel. Let's put it that way. Each other. So, the markets have really been taking a hit. Where is it going? Who knows? We'll see. But here's the story I wanted to talk about. So they're hitting me with pop-ups. Do crypto losses trigger tax losses with the IRS? Well, that's a very good story, isn't it? That's a very good question. And crypto markets are notoriously volatile, but even so, the recent activity has been unsettling. Whether you are a buy and hold investor or an active trader with high frequency moves, it is nerve-wracking, and it may not be over yet. For some, it can be downright devastating, particularly if you had to put all your nest eggs in Terra or Luna. These are the coins that have collapsed. But even those may bounce back, as Luna has shocked some by staging a surprise rally. In the meantime, the turmoil may make plenty of crypto investors, as well as people in various crypto and crypto-related businesses, less enthusiastic than they were when the prices seemed ever to be climbing. It's always the case, isn't it? But can some tax losses help? As your dollars shake out in the digital world, is there any lemonade you can make by claiming your losses on your taxes to share the pain with the IRS? First, ask what happens from a tax viewpoint. If you've been trading and triggering big taxable gains, but then the floor drops out, consider whether you can pay your taxes for the gains you have already triggered this year. Taxes are annual and generally based on the calendar year, unless you have properly elected otherwise. Start with the proposition that each time you sell or exchange a cryptocurrency for cash, another cryptocurrency, or for goods or services, the transaction is considered a taxable event. We've talked about that over and over on this show. What is a taxable event when it comes to crypto? Almost everything. That is a result of the IRS shot heard round the world in the notice in 2014-21, when the IRS announced that the crypto is property for tax purposes, not currency, not securities, but property. So most any transaction means IRS wants you to report. Before 2018, now get this, before 2018, many crypto investors claimed that crypto to crypto exchanges were tax-free. But that argument was based on a section 1031 of the tax code. 1031 now is I think it says it in this, is regulated to only real estate. But it used to apply to anything, real estate or any other investment. But now it's just real estate. And one of the reasons why it's just real estate is just here, because they didn't want the crypto to crypto exchanges to be like-kind exchanges and therefore tax-free. And so they changed the rules. It was a good argument depending on the facts and the reporting, but that argument went away starting in 2018. Section 1031 of the tax code now says it applies to swaps of real estate only. Big change. The IRS is auditing some pre-2018 crypto taxpayers, and so far doesn't appear to like the 1031 argument, even before 2018. The IRS even released one piece of guidance saying that tax-free crypto exchanges don't work. We may need a court case to resolve it if the IRS pushes it that far. After all, it only applies to 2017 and prior years, so is of diminishing importance. But regardless of whether you use crypto to pay someone, swap crypto, or outright sell it, do you have gain or loss? For most people, gain or loss would be subject to the short-term or long-term capital gain losses based on the basis, what you paid for the crypto, holding period, and the price at which the cryptocurrency was sold or exchanged. Yet some people may have ordinary gains or losses, and that topic is worth revisiting. Are you trading in crypto as a business? Very difficult to do, by the way. Although most investors want long-term capital gain rates on gain if they buy and hold for more than a year, ordinary treatment could be helpful for some, especially for losses. Security traders can make a Section 475 mark-to-market election under the tax code. But does that work for crypto? It's not clear. I could say that if it's not clear, the IRS is going to say it does not. To qualify, one must argue that the crypto constitutes securities or commodities. We already know the IRS position on that. The SEC has argued, and this is why some parts of the government are against, whatever's best for them, they claim. The SEC has argued that some crypto are securities, and there may be arguments for commodity characterization too. Of course there are. It's at least worth considering in some cases. However, in addition to establishing a position that a virtual currency is a security or commodity, you would need to qualify as a trader in order to make a mark-to-market election. Again, very difficult to do. Whether one's activities constitute trading as opposed to investing is a key issue in determining whether one is eligible for mark-to-market, make a mark-to-market election. The IRS lists details about who is a trader. usually characterized by high volume and short-term holding, although sometimes investing and trading might look rather similar. If crypto turns out to be eligible for mark-to-market, and if you qualify and you elect it, you can mark-to-market your securities or commodities on the last day of the year. Any gain or loss would be ordinary income, and gains too. A benefit would be that the cumbersome process of tracking the date and time that each crypto was acquired and identifying the crypto you sold would not be required. For most people, this won't make any sense, but like so much in the crypto tax world, much is uncertain. In the past, some drops of crypto value have been called a flash crash. Investopedia defines a flash crash as an event in electronic securities markets where the withdrawal of stock orders rapidly amplifies price declines and then quickly recovers. In the case of stock, the SEC voted June 10, 2010 to enact rules that automatically stop trading on any stock in the S&P 500 whose price changes by more than 10% in any 5-minute period. With the market falling off a cliff, there would be big losses, right? Not necessarily. It turns out that many investors sold stock at a gain because of a stop-loss orders. A stop-loss order directs a broker to sell at a best price available if the stock reaches a specified price. Because of the whopping and sudden decline in stock prices the afternoon of May 6, 2010, many stop-loss orders were triggered. How does this apply to crypto, which has been especially volatile? We don't know, but flash crashes of stock are a useful analogy. In 2010, in the wake of the flash crash of stocks, the IRS had its say about taxes. And in IRS Information Letter 2010-0188, the IRS responded to a request from investors' brokers that investors should be allowed to reinvest the stock they sold, and the investment stock should be given the same basis as the stock they originally held. And investors should be excused from recognizing gain. Appealing as this sounds, the IRS said it did not have the authority to grant this relief. Not sure they would, even if they could. And of course, even if they could, they would say that they can't. Maybe this makes you think of a wash sales, where you sell stock to trigger a loss and then buy it back. But this is the flip side of a wash sale, and it turns out there's nothing in the tax law to allow you to defer any such gains. In the notice, the IRS agrees that the wash sale rule of Section 1091 of the tax code can prevent you from recognizing a loss. A stop-loss order works by automatically closing a position when the price hits a predetermined level. Stop losses can thus help manage your risk. Notably, there's no rule prohibiting crypto owners from buying and selling as much as they want. There are no wash sale rules like those that apply to stocks. You can sell your crypto and buy it right back without a 30-day waiting period. What does that mean? That means you could take losses and then buy it back, and when it goes up, you don't have to take the gain, right? If they're at a loss now, you can sell, take the loss, and then buy it right back. So you still have the same position, but now you get some tax losses. That's what a wash sale is. Well, that's what a wash sale is, but the wash sale rules for stocks say that you can't take that loss, but those don't apply to crypto, as was just said. Here's another story I wanted to just kind of touch on. The IRS may be missing out on $50 billion a year in unpaid crypto taxes, and the crackdown is underway. And again, we've been talking about the IRS crackdown on crypto for some time. The Internal Revenue Service may be missing out on more than $50 billion a year from crypto traders not paying their taxes, and the agency is taking notice. In a new analysis by Barclays last week, managing director estimated that the tax gap from crypto trades, the difference between how much revenue the IRS collects and how much it is owed, may be as much as $50 billion per year. Barclays made the calculation by exploiting data referenced by the IRS in 2017 to estimate that the current crypto tax gap represents a full 10% of the overall national tax gap. Although now they tell us the tax gap might be as much as $1 trillion and not $300 billion or $500 billion. However, the gap is much larger, according to Barclays, because much of the DeFi activity occurring today did not exist 4 years ago. Much more trading now. But of course, there's a lot more rules and a lot more reporting than there was 4 years ago, too, which stands for decentralized finance, aims to recreate traditional financial systems such as banks and exchanges with cryptocurrency, most run on Ethereum blockchain. While all transactions may be visible on blockchains, if all the counterparties are anonymous, it is difficult for the IRS to figure out who owes taxes. Again, there's a lot better reporting. I wouldn't know if it's better, but there's a lot more reporting from these exchanges to the IRS. So there's not as much nefarious activity, or anonymous activity, I should say. Without any supporting IRS data, our sense is that the $15 billion estimate for the crypto tax gap is probably too small. This isn't to say that crypto traders should try and get away with not paying taxes on their gains. Instead, they should be more diligent than ever in reporting, as the IRS has greatly increased its crackdown on would-be crypto tax evaders in recent years. The IRS has been leaning very hard, investing in both personnel as well as process and form amendments. For the past 2 years, the first item that the taxpayers have accounted on their 1040 forms after filling out their contact information is a question asking, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency, which taxpayers must answer under penalty of perjury? We reviewed this a lot on this show. If you answer no and don't report the crypto gains, now there's an intent behind this willful negligence. The best course of action for crypto traders is to be upfront and honest on all their taxes about the crypto purchases and the sales that they make in a given year. As a tax attorney, I also subscribe to that. You should be open and honest because the alternative is not good. Because the IRS audits on 2-year lag, Woodward says that the traders who failed to report gains in the past may still get caught. He recommends keeping detailed records of your transactions so that you can answer any questions that the agency may have for you. This is key for anything. Keep records. I can tell you by representing people who had crypto, the problem is the records. If you need to amend a previous tax return, you can do so electronically with the IRS at this link. I think the best approach for all cryptocurrency users is to act like it's not anonymous at all. Just because you feel like you're safe and in the clear a few months after you file your tax return. That is not the case. This thing can linger for many, many years. That's true. And so you have to be careful. And again, my advice is always to follow the rules and report everything. That way you don't have to worry about it, and you can sleep good at night. Well at night, I should say. So anyway, that's where that goes. And so I want to thank you so much. I didn't think I'd get that second story in, but we did, and I appreciate it. I thought it was important to get to. There's another story here that I wanted to, that I was going to talk about, but let me just go back to this here just for a second, because the rise of the crypto cop and what's happening there, the rise of the crypto cop. This is a good story. It's linked below, so maybe you want to take a look at it about hiring people to investigate these crimes that are crypto crimes, because there really isn't any way nobody knows how to do it because it's new. So nobody knows how to do it. So ask you to like and share, subscribe. We need your help to get this content out. So please help us get this content out. We'd appreciate it. And remember, if you owe the IRS money, if you let's do that again. If you owe the IRS money, if you know you haven't filed your tax returns in some years, and of course you know if you haven't, and you don't know what to do, first thing you should do, get a copy of my book, Deal with Your IRS Problems Today. Go to freeirsbook.com, freeirsbook.com. Get your free copy. Get it today, freeirsbook.com. So thanks again for watching. We'll be back tomorrow with today's Tax Talk, talking about taxes and the news. Won't you join us?